In Roman 3, they are telling us, in Roman 3, not Roman 3, actually Roman 4, explain the explanatory power of the model using the coefficient of determination. So remember, coefficient of determination is normally R squared. So it gives the explanatory power of a regression equation, It gives the explanatory power of a regression equation, I mean, up to what percentage are we able to explain? The dependent variable? Up to what level are we able to explain the changes in the dependent variable as a result of the independent variables that we have? If, for example, we have our dependent variable as y equals a plus bx. So you see this y, as this x changes, this dependent variable changes. So in this case here, if this change in x is able to account, say, for 90% of the changes in y, then we shall say that, x is able to explain y very well. The explanatory power is very high. So R squared basically gives us the explanatory power of a regression equation. If, for example, x is able to account for 100% changes in y, then that is very good, perfect. If x is able to account for 90%, it means that there must be a hidden variable, a variable that we do not have here, a hidden variable that is able to account for that 10%, that is able to account for the 10%. So the higher it is, the better for us as statisticians here, for us as researchers here. All right. So then, ladies and gentlemen, what do we have here? Of course, you will have two types of what here? Two types of coefficient of determinations. We are supposed to work with the adjusted. But of course, it will be better for you to just interpret using the two of them. So we have here the ordinary. We have the ordinary R squared. Are you able to see this ordinary R squared? I can see R squared ordinary. It is 0.96, 9285. So this is 96.9285%. So let's first of all interpret this. So, ladies and gentlemen, what are we saying there? That the regression equation, first of all, is excellent. The regression equation is excellent, is very good. So the regression equation is a very good predictor model. The question is, why? Why? You see here, the R squared is 96.9285, which is the rule of the thumb, whenever it is more than 75%, more than 50% is good. 75% is the excellence level. Anytime we talk of 75% and above, 75% and above, we say it is what year? It is very good. Actually, it's excellent. It's very good. Excellent. More than 75%. All right. So then what does this mean? It means that. What does this mean? It means that the model, it means that the model can explain 96.9285%, 0.85% of the changes in the dependent variable, of the changes in the dependent variable. Changes in the dependent variable. Changes in the dependent variable. i.e. the unexplained variance, the unexplained variance proportion. The unexplained variance proportion is 1 minus 0.9692. So 92.9285% is what we are able to explain. So the unexplained variance proportion will be, of course, the complement. Is there somebody who can, it must be a very small one. Somebody who can give me this. This minus this gives me what figure? First of all, give me this figure. This will become very clear as we progress. This will become very clear as we progress. So 1 minus this. So 0.031. So 0.031, which is the same as 3.1%, is what, in this case here, can't be explained by the model. So the margin of error is really small. This unexplained variance is the margin of error. The unexplained variance is the margin of error. It is very, very small. So whenever they 96 point what here? 96.9285 is really, really powerful here, because you're able to explain like almost everything, like almost 100%. So meaning that the model is very, very powerful. The model is very, very powerful. So you see here, they have given you 2r squared. They've given you 2r squared. We are supposed to be working with adjusted always, but I've always seen your examiner, your examiner explaining these ones. So the better thing to do is to explain both of them. You explain both of them. So in this case, you've been able to explain the normal one, Are you able to see the adjusted r squared? Is there somebody who is able to see the adjusted r squared? Is there anybody who is able to see the adjusted r squared? Anybody who is able to see the adjusted r squared? From the table, are you able to see the adjusted r squared? It seems these guys can't see. It seems these guys can't. Yeah, all right. So then how do we explain? You simply write it there, adjusted r squared. You simply write it there as adjusted r squared. Adjusted r squared. You use the same language. So adjusted r squared, the adjusted r squared from the table, the adjusted r squared from the table is 0.9616, 0.9616, 07 like that, which is the same as 96.1607%. So of course, remember adjusted r squared, we are adjusting our ordinary r squared to reflect the multiple independent variables. We bring in factors here to adjust. You're not supposed to understand that. We're only supposed to understand how do we interpret this. So again, what do? You'll simply come and tell us that the model is able to explain 96.1607% of the changes of the dependent variable. So we can easily, in this case here, account for 96.1607% of the changes in the dependent variable. What I would want to hear in this case here without a fail is the concept of the unexplained variance. Unexplained variance proportion. This one here will be 1 minus, of course, this 96.1607. Are you able to give me this figure? Yeah, Vero is giving me 3 point something, yeah? 3 point something, 3.893, 3.8393%. So this is the unexplained. So meaning that, it's very hard for you to be perfect. I told you yesterday, chasing for perfectionism is a very, very costly thing. If you're a perfectionist, even at your workplace, if you are that kind of a person who does not expect others here to make errors, I'm telling you that is a disease. That's a disease. Have you ever worked with managers who are kind of perfect, who expects in this case here perfectionism? Have you ever worked with those kind of managers? Have you ever worked with those kind of managers? Is there somebody who has ever encountered one? Somebody who is even at marriage level, I'm telling you, if you get in this case here, for example, a husband who in this case here is always a white carpet husband, wants to do everything, if it's ironing, like the way you make in this case here, your bed, I mean, all the four corners as if you are in the army. I mean, that is a disaster. That's a disaster. I'm not saying that we should be dirty, but I mean, if you are up to 90 or even 60% is very good. Even 60% is very good. Don't expect in this case here, I mean, never over-expect. Over-expectations are not good. They are not good. They are not good. They are not good. So in this case here, 3.8. So here we are able to account up to, we are up to 96% good. So in this case here, our just shortcoming is this. So this is very low, meaning that this is low. This is very low here. This is very low. The unexplained variance is very low, meaning that the model is what here? The model is very good. The model is very, the model is very good. The model is very good. The model is very, the model is very good. 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 So whenever they talk about coefficient of determination, always remember it is the percentage. Once you have the percentage, then the rule of the thumb, basically, if it's very high, very good. If it is below 50%, anything below 50%, that is very poor. Honestly speaking, even in our lives, even in our normal lives, if you are below average, then that is very, very bad. If it's between 50% and 75%, we talk of modest. We talk of average. If, for example, you got an R squared, listen here, if R squared is more than 75%, excellent, or very good, excellent here, or very good. And then if R squared falls in between 50% to 75%, we talk of, in this case here, average, modest, like that. Average. So it's a model that is averagely good. All right. And anything in this case here, ladies and gentlemen, that is less than 50, if R squared is less than 50%, this is very poor. This is very, very poor. Very poor model. Don't use it for prediction. Don't use it for prediction. Although these are just the rules of the thumb, it depends on when you get a number. Like, for example, even in primary school or even in high school, when you guys were getting 80%, if you got 80%, of course, not unless your teacher was very mean, 80% your teacher must have been writing there very good. Very good. 80% is very good. 80% is very good. All right. Now, if you allow me, I will be able to go straight away to the next question here that is asking, which is the last question here, that is asking about, explain if the independent variable is economically plausible as a predictor variable. So remember, plausibility means what here? Making sense. Does it make sense? 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 So plausibility, plausible means what here? Making sense. So under plausibility, we ask ourselves here, does the relationship make sense? Make sense. Does it make sense? Plausibility. Does it make sense? Now here we normally look at two things. We normally look at two things. As a researcher, if, for example, I have here sales equals 10,000 plus 2 times advertising cost. What do you know about advertising cost versus sales? The more we advertise, the higher the sales should be. The more we advertise, the higher. So I expect a positive relationship. I expect a positive relationship here between sales and advertising cost, because the more I advertise, the more the sales should be. So in this case here, just by looking at this, I'm able to deduce here that the relationship in this case here is economically plausible. Because the relationship is If, for example, I got something like this, sales, after I've gone to data collection, I've collected my data, then I enter this data in the SPSS, the research tool. And then I get, for example, sales equals 10,000 minus 0.5 times advertising cost. So does this really make sense? Does this make sense? Does it make sense? The way Frida just reason here. Does this make sense? This relationship, does it make sense? Does it make sense? Here, that sales and advertising cost have a negative what here? Relationship. Does it make sense really? Is it possible sales and advertising cost to have a negative relationship? No. So this is what we call economically not plausible. It doesn't make sense. It doesn't make sense. So such relationships, I should be able to identify them and drop them. Because, you know, as a researcher, what do you expect? As a researcher, what do you expect? Just like, for example, you're doing a research. We have here price versus demand. Price versus demand. So price versus demand. What do you expect of these two variables? Are they supposed to be negatively related or positively related? What do you expect of them? Because also as a researcher, you need to have expectations from the word go. You must be having expectations from the word go. You must be having expectations. There must be. As I carry out my research, positive? No. Price and demand. Price and demand can't be positive. Think again. Think again. Think again. Think again. Think again. They can't be positively related. They can't be positively. Because in this case, I remember people will buy more at a lower price. People will buy more at a lower price. As the price goes down, people buy more. People buy more. So I expect a negative relationship. Yeah, the higher the price, the lower the demand. The higher the price here, the demand will be very low. So they are negatively related. So as a researcher, as I regress these two into a model, I expect to get a negative relationship. So then what if now I've done my data collection? I've done my data collection. Once I've done my data collection, I regress this. I put this in SPSS or in what we call R. You can also use R software. So you go ahead and put this in SPSS, and then you get like price equals A plus B times quantity demanded. I get this. Then I should be able to discuss with my supervisor. Tell my supervisor I got, in this case, a relationship which I don't trust. Yeah, prayer time. Prayer time. All right, so she'll come back at exactly 7. Great. So we stopped at the point where we were looking at, I mean, if you have got two functions like this, two variables, price and demand, as a researcher, I should be able to have like a premonition. I should be able to think through in advance. What kind of a relationship do I expect? What kind of a relationship do I expect? Like in this case here, price and demand. So here we expect price, the higher the price, the lower the demand. The price is very high. So I expect as the price goes down, then demand should be able to increase. So from the word go, I expected to get a negative relationship. So then if I do my regression and then I end up getting a positive relationship like this, then I should be able to call my research supervisor. Tell my supervisor, I mean, I'm getting this. I will need more time. I have to do some investigations. Why? Because I've gotten what we call a spurious. I've gotten what we call a spurious relationship. You'll be asked about this. Spurious means what here? Nonsense. A relationship which does not make sense. A relationship that does not make sense. Spurious. A relationship that does not make sense. So then for us to be able to understand whether our relationship makes sense, we must know the variables. we must know the variables. Like here, is there somebody who can tell us in the question that we are doing, what are the variables involved? Which variables are involved here? Which variables are involved? Which variables are involved? Which variables are involved? Which variables are involved? Why they are not talking to me? Process of estimating the fixed cost and the variable costs components associated with the company's repair activity using the cost estimates. So they have told us there where the equation is y equals a plus bx. Yeah. So we have here cost, which equals a plus bx, where x in this case here is what here, where x, they have told us what x stands for. X in this case here, number of hours. So basically cost equals a, you guys had given me a, you guys had given me the coefficients. We had 409.91 plus 29.40. And then we have x here, where x is hours times hours like that. So then I have to look at my repair cost vis-a-vis hours. For sure, we expect in this case here as the hours, the time on the road increases. As the time on the road increases, what happens to repair cost? What should happen? I mean, I should have asked this question like this. What should happen? As in this case here, the running hours on the road increases, then automatically the repair cost should be doing what? It should be increasing, yes, increasing. Which reminds me, I was watching some clip in the morning today where some teacher was asking about whether pressure increases or decreases. And those high school students in this case here were confused. So they ended up telling this teacher that it increases. So in between increasing and decreasing. So it increases. But this one is not decreasing, ladies and gentlemen. We appreciate the fact that as hours are going up, in this case here, the cost must be going up. That is why, ladies and gentlemen, if possible, even yourself, for example, when you buy a motor vehicle, don't use a motor vehicle for over 3 years. If it's a good small Toyota car, you run away with it throughout like this. By the time it is hitting like the 4th year, sell it. Because you'll be able to sell it at almost, if you are maintaining it very well, you'll be able to sell it at almost the same price. Why? Because the older it becomes, the higher the repair cost will be. The older it becomes, the higher the repair cost will be. I would rather in this case sell my old thing, then I bring in a new vehicle, which has got, in this case here, fewer hours, fewer miles, for me to continue again, in this case here, using it as my labor cost is minimum here. So first of all, we are saying here that hours and the costs are expected to be positively related, full stop here. From the equation above, comma, they have a positive relationship. They have a positive relationship. So it means that this thing makes sense. It means that it makes sense, i.e., the relationship is what here, i.e., the relationship is plausible. It makes sense. The relationship is plausible. It makes sense. Yeah, Chris, yes. It makes sense, yes. So from the equation above, we have a positive relationship. If it was negative against our expectation, then we would have said, no, this is spurious. It's not plausible. But here we expected the relationship here to be positive. And at the end of the day, it is actually positive. And therefore, in this case, it is what here? It is plausible. Now, please listen. Now, fine. We have said in this case, it's plausible. So should we go ahead and then just say that this model is very good? Use it? No, I'll still be forced to do what we call a significance test. I must do what we call a significance test. do a significance test between hours and the cost. So in this case here, we need a significance test of the predictor variable. So significance test of the predictor variable, this one here, hours. I'm so sure, ladies and gentlemen, you may have forgotten how to do this significance test. I'm so sure you must have forgotten how to do this significance test. I don't know whether, Paul, you got some time to have a look at this. So this significance test of the predictor variables, we normally use the T statistic, and it's normally a two-tail test. T significant. T. So is there somebody who is able to read for us, first of all? First of all, are you able to read for us? Are you able to read for us here? HO and H1, yes. Are you able to read for us here? Are you able to read for us the coefficient? Oh, yeah. Remember, this is for the variable X, predictor variable X. Predictor variable X, I can see abracadabra 22 point something. Oh, yeah, lower. Oh, yeah. Lower, I can see 22.13 or 14. I want to make this simpler. And then we have here 36. Then we have 36.67. 67. How about the T calculated? Now, first of all, before I continue, we shall overcome. We shall overcome. Thank you very much, Vero. We draw the mountain. So is there somebody who is able to see? First of all, before you tell me, in this case, here's something about reading from the question, is there somebody who knows the formula of getting T calculated? Is there somebody who knows the formula of getting T calculated? Is there somebody who knows the formula of getting T? Okay. No, NJ, no. But you've tried. NJ, no. But you've tried. Thank you very much, Paul. Thank you very much, Celine. Coefficient over standard error. Coefficient over standard error. This is a very important formula. Fortunately, they have done, these ninjas have done this for us, fortunately. Fortunately, they have done this for us. They have given us the T calculated, what they are calling the T statistic. The T statistic. They have given us 11 point what here? 11.23 or 11.24. Are you able to see the 11.24 for the predictor variable? Are you able to see 11 point something? Is it 11.19? Am I the one who is not seeing this? 11 point something. 11 point something. Am I the one who is not seeing this? 11.23 something, yes. 11.23 something. So, ladies and gentlemen, in this case here now, remember, in this mountain of hours Vero is talking about, this is H0, this is H1, empty is H0, empty is H0, empty is H0. So then can you kindly tell me, where are you able to see this 11.24? Where are you able to see this 11.24? The abracadabra, is it here? Abracadabra. So in this case, I'm able to see, ladies and gentlemen, rhodiums. Rhodiums, look at this. You know, this is not negative. 0 is not here. 0 is somewhere here. So 11.24 will fall somewhere here. Rhodiums, check this. 11.24 will, in the number line. In the number line, 11.24 is less than 22.14. So 11.24 will fall somewhere here. Rhodiums, are we together here? Rhodiums, are we together here? Great. So in this case here, 11.24 falls in the H1, region. And therefore, the predictor variable is significant. It's not empty. This is empty. Empty, no shadings, empty, nothing. So this one has got something here. And therefore, the predictor variable is significant. So this confirms the plausibility assumption. This confirms the plausibility assumption. So you normally do this after you've checked the general one, the theoretical one, then we come and now look at the significance. If it's insignificant, I mean, and you had said updates plausible, it will be not proper. You can't use it for prediction. You can't use it for prediction. So, ladies and gentlemen, that is what we do. At least you have an idea. At least you have an idea. At least you have an idea. In a question of 14 marks, my concept is, I'm not looking for perfection. What I know, ladies and gentlemen, perfectionism is a very costly thing. Perfectionism in life is a very costly thing. It can even cost you your marriage. So for me, out of 14, if you guys are able to get like 8, 10, I mean, you are very good. At least you know how to compute the T, you know how to the F, you know how, in this case, you are good to go. You're good to go. You are good to go. Otherwise, I would want us straight away to look at something different. So mention there, assumptions of regression analysis. Assumptions of regression analysis. Assumptions of regression analysis. Assumptions of regression analysis. So assumption of regression analysis, the first one is linearity. Number one, it is linearity. Linearity, because of y equals a plus bx. So linearity, that the relationship between relationship between independent variables, independent variables, and the dependent variable, and the dependent variable, and the dependent variable is linear. Is linear. Is linear. Is linear. So the very important thing is you test. How do we test for linearity here? For linearity, we plot a scatter diagram. A scatter diagram. We plot a scatter diagram. That's how we test for linearity. You plot a scatter diagram, and then of course you'll be able to see how the points are scattered. How the points are scattered. If you get points scattered like this, then you can see in this case, at least there is a pattern. You can be able to get what we call a line of what here, line of best fit, which will be what here, straight line, which will be straight line. So we plot a scatter diagram. But if, for example, you were to plot a scatter diagram, and then you end up getting, for example, something that, I mean, you can't even see the tail, nor in this case here, the head. So here you can't really conclude that there is any linearity. We expect, if it's linearity, we expect to see some pattern here that you can use now to do a line of what here, best fit. So the first assumption is the assumption of linearity, and for us to be able to test it, ladies and gentlemen, we normally use that concept of what here, that concept of scatter diagram. That is it. Then number two, we have independence of observations. Independence of observations. Independence of observations. Of observations here. Independence of observations. Independence of observations. That observations are independent of each other. Observations are independent of each other, They are independent of each other. That if, for example, I take you guys to be in my sample, so you bring in, for example, somebody tells me this vehicle of mine has done 10 hours, and this was the repair cost. I bring in a Muhaya. A Muhaya tells me that this vehicle of mine has done this number of hours and this. So I expect you guys to be very independent of each other. Otherwise, in research, if I put you together and then you discuss, you can easily cheat. So in this case, the observations are normally independent of each other. They are independent of each other. They depend on each other. And then how do we test? So the test here. So to test, we use the Durbin-Watson, the Durbin-Watson 1, 2, 3 rule. The Durbin-Watson 1, 2, 3 rule. The Durbin-Watson 1, 2, 3 rule. Durbin-Watson, we also draw this mountain of ours. Our ugali here, we draw our mountain. So we have a 1, 2, 3. Although this one for Durbin-Watson, the significance is here. The significance is here. The significance is there. So we have our H1 being here. Our H1 being here. This is our H0. This is our H0. It takes the opposite of the T. So it's 1, 2, 3 principle. You have to draw this. You must draw this mountain. Yeah, Durbin-Watson statistic, the DW. So then what will happen is this. You will be given two models. Like the first model, for example, Durbin-Watson could be 2.3. Another model, Durbin-Watson for model 2 would be like 5. And then we have another one, Durbin-Watson 3, another model 3, it will be 0.8. So please listen. It means straight away this 2.3, where is 2.3 significant? So 2.3 is somewhere here. So it means that this is good. Good. So good here will mean independent. The observations that you took here are very independent of each other. Why? Because the Durbin-Watson of the model is falling here. The Durbin-Watson of the model is falling there. But if you look at Durbin-Watson 2, for model 2, it's 5. Where is 5? 5 is out of range. 5 is out of range, more than 3 here, out of range. So in this case here, that model cannot be used because there is what we call dependence concept. Dependence. So for us to say that the observations are very independent, then we expect the Durbin-Watson statistic of our model to be in between here, 1, 2, 3. 2 is the perfect. If it falls at exactly 2, perfect. But anywhere here between 1 and 3, this is acceptable. This is acceptable. This is acceptable. This is acceptable. So I would want you to put a note there. I would want you to put a note there and tell us there that when observations are independent, when observations are independent, when observations are independent, when observations are independent, then the model does not have serial stroke auto correlation. Does not have serial stroke what we call auto correlation. I know this may sound Greek. Serial stroke what here? Auto correlation. Serial or auto correlation. It's supposed to have just like a high level understanding of this. You're not supposed to get into really details. No. All right. Ladies and gentlemen, from there, if you allow me, I will look straight away at the next one, what we call homoscedasticity, the third assumption. That regression assumes regression assumes homoscedasticity. Homoscedasticity. It assumes homoscedasticity. Regression assumes what we call homoscedasticity. Regression assumes what we call homoscedasticity. So homoscedasticity, if for example, because we also use a scatter diagram here, if I have my line of best fit, all right, I have my line of best fit. If I happen to be having a point here, I should be having a point exactly opposite here. So that at the end of the day, our line of best fit is able to cut these particular plots into two. Homoscedasticity means what here? Equal. It is the opposite of a heteroscedasticity. So this is a homoscedasticity. It assumes uniformity of these points here. Please draw this. So like now this is a homo. This is a homo here. The distance between here equals the distance between here and there. Homoscedasticity. So regression assumes homoscedasticity. It assumes a homoscedasticity. It assumes a homoscedasticity. i.e. the variance of the residual is constant. i.e. the variance of the residual, i.e. variance of the residual, 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 variance of the residuals, variance of the residuals is constant. Is constant across all levels. Across all levels. Across all levels. Across all levels. So in statistics, if you're told that, for example, the data is having what we call a heteroscedasticity, then automatically regression is only limited to homoscedasticity situations. If you get your data being hetero, it has a heteroscedasticity like this, heteroscedasticity like this, then automatically you can't use regression because regression makes these assumptions here. Regression assumes homoscedasticity. Regression assumes homoscedasticity. Regression assumes what we call homoscedasticity. So I can see Faiza crying there. No, you see, you'll be asked. They don't want you to go into all those details. If they just ask you for 8 marks, what are the assumptions of regression analysis? 8 marks, and then you tell us how do we test them. So you should be able to remember homoscedasticity. I should be able to remember homoscedasticity. 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 One of the assumptions here. One of the assumptions. So have you guys written up to there? Have you guys written up to there? Can I continue? Can I continue? Have you guys written up to there now? Can I continue? All right. So number 4, ladies and gentlemen, normality. We have number 4, normality of residuals. Normality of residuals. Normality of residuals. So tell us that regression assumes that residuals are normally distributed. It assumes that residuals are normally distributed. They are normally distributed. It assumes that residuals are normally distributed. They are normally distributed. They are normally distributed. They are clustered around some mean. If you remember the normal distribution here, I mean, most of them, if you try to draw what we call a histogram, by the way, here to test, we draw a histogram. A histogram. To test this normality, we draw a histogram. A histogram. So you realize when you take, in this case here, the residuals, your points here, in terms of numbers, if, for example, you have X bar is 20, you'll get, like, for example, 10 of them have this X bar of 20. 10 of them. You'll get like 2 of them have an X bar of, say, 3. So in this case here, towards, when we talk of the mean here, most of them will be clustered around the mean. Most of them highest frequency. Highest frequency. Beyond, when you go below the mean here, Now, in this case here, this probability becomes smaller and smaller. So if you are to do, you know, somebody may ask, but Mwalimu, you have said they follow linear. How comes? No, here I'm talking about if you are to do a frequency polygon. If you're to do that frequency, you're counting, this is the mean. How many observations? How many observations? And then now you draw that frequency curve. What do you call the histogram? You'll be able to get that your distribution will be like this, like this. There are very small probabilities of us getting to the tail here. Very small probabilities of us getting to the tail. So it assumes normality of what here? The residuals. Normality of the residuals. The last one. It assumes that there is no multicollinearity. The last one, it assumes that there is no multicollinearity. It assumes that there is no, it assumes that there is no multicollinearity. Multicollinearity. It assumes that there is no multicollinearity. Now, please listen. You see here we have, for example, y equals a plus b1x1 plus b2x2. You see, x1 is supposed to be related to y. So seriously, if possible, 90%, 100%. x2 at the same time is supposed to be related to y. But x1 and x2, they are not supposed to be related. x1 and x2 are not supposed to be related. If they're related, then we shall talk of there being many relationships. There being many relationships in the model. Many relationships in the model. So there is no multicollinearity, and we are writing there. The independent variables, the independent variables are not supposed to be significantly related. So these x1 and x2 are our independent variables. x1 and x2 are our independent variables. They are not supposed to be significantly related. They're supposed to have a relationship with y, but they themselves are not supposed to be having a significant relationship. They're not supposed to be having a significant relationship. So testing, how do we test? In this case here, using correlation matrix. You use what we call the correlation matrix. Now, ladies and gentlemen, amongst the 5 or 4 assumptions that I've given to you, which assumptions will you not? Which assumptions in this case here will you not forget? Which assumptions will you not forget? Which assumptions you will not forget? So we have linearity. Everybody's thinking about linearity. Homoscedasity, I love that. Homoscedasity, the concept of homogeneous distribution of the residuals. Homoscedasity, Mercy, yes. Homoscedasity. Linearity, normality, homoscedasity. Thank you very much, Celine. Linearity, normality, homoscedasity. Normality of residuals. Independence of observations. Independence of observations, or there being no auto, if you remember the concept of what here, we should not have, in this case here, serial correlation, serial or auto correlation, if you remember that. Multicollinearity. Great. So you guys are great ninjas. So somebody is telling me that Mwalimu use simple English. Imagine that is what you will get in your exams. If you're keen enough, we have tested this before, where we tell you, for example, explain what you understand by homoscedasity. So if I use simple English and then you get hard English in the exam, won't you blame me? I would rather teach you these things the way they are, the way they are asked. So if they ask you, for example, what is multicollinearity, we'll be able to explain and tell that, and even use that example, like y equals a plus b1x1 plus b2x2. Tell us that x1 and x2 are supposed to relate to y. But X1 and X2, being independent variables, are not supposed to relate. And if they relate, then we are going to have many relationships. This concept of many relationships is what we call multi-collinear. You need that kind of just understanding, and then we shall overcome. And then we shall overcome. We shall overcome. Look at now Frida, she's sweating, imagine. I mean, is this very hard? There's not even any mathematics there. Frida, is this very hard? Is this very hard? Homoscedasticity means what here? Uniform. Multicollinearity, we don't have many relationships in the model. All right. We have independence of observations. Of course, the sample where you're getting, in this case, your observations from, they're not supposed to be related. We shall overcome. We shall overcome. So long as you're able to get it like high level, then that will be it. That will be it. Ladies and gentlemen, with your permission, I should now be able to go to the next topic here.